Good day, this is the Asymmetric Daily Brief for Thursday, August 6, 2026. Here is the shape of today. The Dow is printing records, the Nasdaq is bleeding, and Bitcoin has gone essentially nowhere for a month. Underneath that split sits the story that actually matters. The company that made artificial intelligence cheap has told its customers to expect a significant price increase, and it will not say how much. That is not a pricing note. That is the end of an assumption a great many models were built on. We will take the tape first, then the three places where we think the consensus has this wrong, then the macro regime, sentiment, sectors, the calendar, and the calls. The board, the S&P 500 closed Wednesday at 7,723, down about 0.2%, snapping a four-session winning streak on technology profit-taking. The Dow, meanwhile, is in record territory. That divergence is the rotation trade doing its work. The Nasdaq 100 is the laggard, with semiconductors leading it lower. Gold closed around $4,244 an ounce after its sharpest single-day move since February. Bitcoin sits near $64,000, and it has been flat for roughly a month while equity indices printed records. The 10-year Treasury yields about 4.63%, with the long end selling off and the curve steepening. The dollar index is a touch softer near 99.9. One sentence, the Dow makes records. The Nasdaq bleeds, and crypto is not in the room. Consensus versus the asymmetric. First read, everyone believes artificial intelligence gets cheaper forever. The tell says the price war just ended, and the cheapest producer blinked first. DeepSeek, the Chinese lab whose pricing forced this entire industry lower, currently charges 14 cents per million input tokens and 28 cents per million output tokens on its V4 Flash model. Those are among the lowest prices in the world. In May, it made a permanent discount that pushed ByteDance and Tencent to cut as well. On Thursday, it told developers a substantial increase is coming and declined to publish a new schedule. The mechanism matters more than the number. Token prices have been falling because the marginal seller was subsidizing them, not because computing got proportionally cheaper. When the low-cost leader raises prices without naming a figure, it is telling you its own unit economics are worse than its price card implied. We hold this with high conviction. Every downstream model that assumes inference costs fall 40% a year is now carrying an unhedged input cost assumption. This is today's focus episode, and there is a link in the description. Second read, everyone believes gold ripped to a record. The tell says gold had a huge day and remains far below its high, and that it rallied for the opposite reason to the one being quoted. Gold closed near $4,244 an ounce on Wednesday after one of its sharpest single-day moves of the year. The all-time high is $5,597.23, set on the 29th of January this year. So this is a violent bounce inside a months-long drawdown, not a breakout. Anyone quoting a market capitalization gain without that context is selling you the wrong story. The driver is the genuinely interesting part. Gold moved as a deal to reopen the Strait of Hormuz came into view. Less energy shock risk means lower expected inflation, which reprices the rate path, which moves real yields, and gold trades off real yields. So gold rallied on the removal of an inflation scare, which is the opposite of the reflex take. We hold the mechanism with medium to high conviction. The level is simply the level. And per our own standing rule, we are quoting the price and the driver, not a contested percentage change, because sources disagree on the exact figure. Third read, everyone believes the crypto market structure bill is coming down to the wire. The tell says the market closed the book on it days ago. Prediction markets price a Senate vote on the Clarity Act before the August recess at 12%, and the bill becoming law this year at roughly 28%, down from a February peak above 80%. Senate leadership has acknowledged there is no floor time left before the recess. The calendar went to a sanctions package and a backlog of nominations, and note what is not blocking it. The largest asset managers and banks publicly endorsed the merge text in late July. The sticking point is the bill's ethics title, the provision restricting federal officials and their families from issuing digital assets. The industry wants the rulebook. The holdup sits inside government, not outside it. Follow the money. The Federal Reserve has quietly flipped from when do they cut to how many hikes, and almost nobody is saying it out loud. Prediction and futures markets put the odds of a rate hike in September at roughly 54 to 56%. A hike is now the single most likely outcome of that meeting. Chair Warsh has signaled he is open to hiking if inflation firms, and core inflation has been running above target on every trailing window that matters. The market's read of the Federal Reserve's silence has been that there is a high bar for hikes. The curve disagrees. The long end is selling off and the curve is steepening. That is not a market that believes inflation is solved. It is a market demanding to be paid more to own duration. Now put the two halves together, because this is the spine of today's issue. Morgan Stanley has United States hyperscaler capital expenditure above $800 billion this year, rising toward $1.1 trillion next year, and the funding mix is changing. Morgan Stanley expects artificial intelligence-related global debt issuance to more than double, to nearly $570 billion this year, with the technology sector needing roughly $1.5 trillion of new debt over 3 years to finance the build. The artificial intelligence trade was equity-funded and self-financing. It is becoming debt-funded. A debt-funded build-out is rate-sensitive by construction, and it is arriving into a Federal Reserve whose most likely next move is a hike. That is the mechanism by which the bubble question stops being a vibe and becomes a credit story. It does not require a crash. It requires a refinancing. Geopolitics is doing the opposite of what the headline says. Iran and Oman have agreed coordinates for new commercial shipping routes through the Strait of Hormuz, with a joint statement in drafting. Oil sold off on the news, but the reported terms include a transit fee of up to 7% of cargo value, and any reopening is conditional on the United States lifting its naval blockade. A toll is not a reopening, if those terms hold. Seaborne energy carries a permanent new cost, which is structurally inflationary, and it is being priced today as de-escalation. We are treating the 7% as reported rather than confirmed. The thing to watch is whether the joint statement actually publishes. And on crypto, Bitcoin has gone nowhere for a month, while equities printed records. That gap is a legislative risk premium, and holders are paying it right now. Market sentiment. Across market and social sentiment monitoring today, attention concentrated overwhelmingly on the crypto bills deadline, on the gold move, and on the large share unlock in the space sector. What that attention missed is instructive. The pricing reversal in artificial intelligence drew a fraction of the engagement of the legislative story, despite being the more durable fact. Positioning commentary also skewed toward rate cuts, which is now at odds with what rate markets are actually pricing. We would flag two specific distortions circulating today. A widely shared framing of the gold move omitted that gold remains well below its January high, and commentary asserting near certainty of a September hike overstates it. The live figure is closer to a coin flip. We corrected both before publishing. The tell, 14 cents. That is what 1 million input tokens cost on the cheapest frontier class model in the world. It is the number that anchored every artificial intelligence deflation spreadsheet built in the last 18 months. It is going up by an amount the seller will not yet name. One price, moving in the wrong direction, quietly invalidates the input assumption in a very large number of models. That is what a genuine regime change looks like before anyone calls it one. Not a crash, just a number that stops falling. Sectors in play. Semiconductors were bearish today and remain structurally unresolved. The bull case is that the $800 billion to $1.1 trillion capital wave lands on their order books. The bear case is that the wave is now partly debt-financed, and that the pricing signal we just discussed says monetizing inference is harder than assumed. The demand is real. The question is who pays for it, and at what cost of capital. Energy is headline-driven and fundamentally re-rating. A Hormuz deal removes a war premium, but a 7% cargo toll is a permanent cost rather than a one-off. The market traded the headline and ignored the term sheet, and crypto-adjacent equities are carrying a policy discount. The framework is written and industry-endorsed. What it does not have is floor time, and September is a thinner political window. On the radar, Friday the 7th, the Senate departs for the August recess, which resolves the Clarity Act vote question outright. The 12% either pays or it does not. Near-term, DeepSeek publishes its new price schedule, and the size of that increase is the story. Wednesday the 12th brings the second share unlock tranche in the space sector, which tests whether the first tranche was absorbed or merely delayed. In September, the Federal Reserve meets, roughly a coin flip on a hike, and the most consequential meeting of the year for a debt-funded build-out. Ongoing, the Hormuz joint statement, which either confirms or kills the 7% transit fee. And through December, the remaining unlocked tranches, which are a 5-month supply, overhang rather than a single cliff. The scorecard, 4 new calls today, each dated and falsifiable. 1. The Clarity Act does not receive a Senate floor vote before the August recess. That resolves tomorrow, and we hold it with high confidence, with the market at 12%. 2. When DeepSeek's increase lands, it is more than 50% on at least one V4 token price. That resolves on publication, medium confidence. Because a company competing on price using the word substantial implies a large move, but they decline to quantify it. 3. Gold does not reclaim its January high of $5,597 before the 31st of December. Medium to high confidence. That requires roughly a 32% advance from here. 4. At least one top 5 United States hyperscaler announces a new debt raise explicitly tied to artificial intelligence infrastructure before year-end. High confidence, because the issuance forecast requires it arithmetically. Carried forward, the capital expenditure financing thesis from issue 66 is reinforced rather than revised. The close, for 2 years every model of the artificial intelligence economy has carried the same load-bearing assumption. Costs fall, not might fall, fall reliably. That assumption is what let a company justify enormous quarterly capital expenditure against a much smaller revenue line. You do not need the revenue today if the cost curve is coming to meet you. On Thursday, the cheapest producer in the market said the cost curve is going the other way. Maybe that is one company managing one balance sheet, but it arrives in the same week the build-out starts borrowing at scale, and the Federal Reserve's most likely next move is a hike. 3 independent facts, 1 direction. What we are watching next is the actual number. Significant is a word. When it becomes a percentage, we will know whether this was a company repricing or an industry. That is the Asymmetric Daily Brief. Research and education only, not financial advice. Today's focus goes deeper on the reversal, and there is a link in the description. I'm Earl. Subscribe.